We're back with the Brass Tax Insights post. Today, we're going to be talking about our fairly recent post about oil and gas K-1s and some self-employment tax tricks that a lot of people are just not aware of. There are a lot of different ways that you can invest in oil and gas, and the tax treatment for each different way is going to be different. The primary person that we're going after here in this section is our working interest owners in oil and gas wells. Okay. How do you know if your client has a working interest in an oil and gas well? They're going to get a K-1 from a partnership, typically. There's other ways that it can be done, but this is the main way. So your client's going to get a K-1 from this oil and gas well, and they're going to be marked as a general partner on that K-1. So that is kind of your indication that, hey, this is a working interest in oil and gas well. I'm going to have very special reporting rules that I have to follow for this. Typically, what you'll see in the first year is that the client will put in a handsome chunk of money, right? Maybe 25,000, 50,000, 100,000 plus dollars. And in that first year, they're going to end up getting this massive intangible drilling cost deduction down in box 13 of that K-1. And there's a lot of confusion about the reporting of this type of thing. So let's just kind of breeze through a couple of different items that fall outside of the scope of this article, and then we'll get into what the article is really kind of talking about. So the first thing is that when your client gets that K-1 that says, hey, you're marked as general partner, check with the client, get the private placement memorandum so you can read what they actually invested in. And if it is actually working interest, meaning they are investing in the drills and the management of that project, then you're going to get access to a whole host of different tax benefits. The first, which is really the cool one, is that when you invest in oil and gas and you have a working interest, that activity is automatically deemed to be non-passive, regardless of your client's participation in that deal. Most of the time, when your client invests in a partnership or something like that, they have to materially participate in order for that activity to be non-passive, to be able to write off losses. Here, with the working interest in an oil and gas partnership, you do not have to do any participation. It is automatically non-passive, which is phenomenal. But now you have to go into the other considerations here, right? So yes, we have non-passive losses. I just told you that in the first year, a large chunk of the client's initial investment is going to go towards intangible drilling costs. On the federal income tax return, these can be written off all in the year that they are paid or incurred, which is great. And so you'll see that show up there on the K-1. But the other thing that you may notice is that up in box 14 of that partnership K-1, you'll see that there is a box for net earnings from self-employment, and it's going to be coded on there, and it's probably going to match the amount of loss or income in box 1 of the K-1. The reason why we have self-employment tax in these working interest in oil and gas wells is because the working interest partnership is operating a trader business. Its trader business is paying the mineral rights owner a lease payment to be able to drill on that land. They are then drilling the oil out of the ground, and then they are selling it to refineries. Okay. So that is a trader business. Now, normally when your client invests in a partnership, they're typically going to be treated as a limited partner. And when you are a limited partner of a partnership, there is an exception for self-employment tax under 1402 that says, hey, if you are a limited partner, if you are functionally a limited partner, we're not going to go into all that fancy nonsense here, but if you are a functionally a limited partner, then you don't have a self-employment tax liability. Even if you're investing in a restaurant or some other type of a trader business because you're a limited partner, no self-employment tax liability. That does not apply here because the taxpayer is not a limited partner. They are a general partner. Okay. And so your client will be subject to self-employment tax on the earnings of these oil and gas K-1s that they're going to get. However, in that first year where they've got those huge losses from intangible drilling cost deductions, those items are going to create massive losses. And so they will have massive net losses from self employment. The problem is that those don't show up in box 14 of the K1. This is the thing that a lot of people miss. They don't put that number there because the partnership doesn't know how much of those intangible drilling costs you'll be able to deduct, because there are lots of different ways that that can be treated on the individual's tax return. The individual might choose to amortize those intangible drilling costs over a 5-year period to avoid something like AMT, right? And so if they do that, that's going to change how much would be included in the net earnings from self-employment. But just because it's not in that box on the K1 doesn't mean that it doesn't increase the net loss from self-employment. So this is something that you've just got to watch out for, especially if you have clients who are in a position where their primary source of income is on a Schedule C or from a partnership that's a trader business and they're receiving lots of net earnings from self-employment. These intangible drilling costs can offset that net earnings from self-employment number and bring it into a net loss from self-employment. And so we've got these citations here on the insights page. I'm not going to go through each and every single one of them because we've got them here. But again, this is a huge benefit in the early years because you've got these big net losses from self-employment. You end up just in a great spot where you're offsetting a huge chunk of your self-employment tax liability. How do you deal with the reporting of this on the return? My recommendation is that when you're doing the K1 input for that working interest in the oil and gas partnership, that you go to box 14A in your software and you increase the net loss by the amount of IDCs that the taxpayer is going to deduct for that year. Again, I've got all the citations for that on the website here, primarily this one, where basically the regs say, hey, if you have separately stated items of deduction that are coming through on a partnership return or a partnership K1, those amounts are included in your net earnings from self-employment. Now, the interesting thing is that some of these partnerships, the taxpayer will start as a general partner, and then after a couple of years, they'll switch to a limited partner. Once they switch to being a limited partner, they should not be subject to self-employment tax at that point, as long as they are functionally a limited partner, which means they're just acting as an investor. They don't have control over how the activity operates. They don't have a functional role in the operation of that partnership. But yeah, I mean, this is an article that I think is really important. If you are missing this and you have clients who are invested in these working interest in oil and gas partnerships, you may have returns that you need to amend for this exact issue. Again, it's really only going to help if you have clients that have, they're invested in these working interests, but then they have other partnerships that they're invested in that, are spitting off self-employment tax, or a sole proprietorship that's spitting off self-employment tax.